I had another agent that came to me saying, hey, listen, I know you use this company. This woman sent me this policy. She's putting in $60,000 a year as a neurosurgeon, right? She's putting in $60,000 a year. Can you analyze it for me? And year one, she puts in $60,000. Guess what? All of it, like any normal whole life policy, all of it goes to pay for the insurance costs. Year two, she pays in $60,000. Guess what? All of it goes to pay for the insurance costs. This means there's zero in that tax-free savings account. All of it's paying for the insurance up front. Year three, she puts in another $60,000. She's now paid $180,000. Now half of it goes to the cash. Now she has $30,000 in there, right? And then finally, by about the fifth year, she's putting in $60,000. It's growing by $60,000 or more. And I showed him, I said, here's the difference. I'm like, see how she paid in $180,000? She has $30,000. Watch mine. Year one, she puts, and then, by the way, this is the same exact insurance company as the one that she was already using, but I was using it how we do it. Year one, she puts in $60,000. She's got $50,000 in that tax-free account, meaning only $10,000 comes out in cost, not all 60. Year two, she puts the money in. It goes from $50,000 to $108,000, right? So even though she's paid $120,000, she's got $108,000 in there. Most of it's all in that cash account. By year three, it's now paying for itself. Year five, she has more than what she paid in. So she paid in $300,000. She has like $311,000 by year five. That's the difference, right? Again, same company. So you mentioned you have to have the right company. That's true, but it's the same company, right? It's all about how you lower those costs. And the great thing is she's not required to pay $60,000 a year. Her minimum was like $11,000 a year, so if she ever has a situation where she can't pay her premiums, good news is if you have at least $11,000, you just pull it out of that account and put it back in. It's almost like pulling from savings to put it back into savings. So the likelihood of it losing goes down. Now, here's the cool part. Because she has cash in there from day one, can she use it? The answer is yes. She can literally access 95% of whatever cash is in there at any time. So rather than waiting till that third year to finally access, 27 grand or whatever, now she's got year one, she's got 45 grand or so that she can access right off the bat from day one. So it just gives you access to more cash. This is why I have people now, the strategy, I'm not having people invest with it right away. I'm telling people, just take your emergency fund and start diversifying it. Just like when people move from a crappy bank savings account earning 0.nothing% into a high yield savings account, do the same thing. In fact, I have a bank savings account because if I want money today, I'll keep money there. I have a high yield savings account with a little bit in it, but my lion's share of my $400,000 emergency fund is sitting inside my life insurance because I can get to it in about a week, and I can get that access to that money at any time. And so I actually have people move a lot of their emergency funds into there first. Don't even invest with it in the beginning. Then after it's already self-funding by the third year or whatever, because if you throw in, say, $10,000 a year, it's growing by at least $10,000 a year, you can invest all that money right off the bat. You don't even worry about the fees because there's no net cost, because now the dividends of the policy is paying for the cost of the premiums coming out, right? And the insurance. So now it's like free insurance at that point. So it's very kind of specific that way, but I tell people don't even use it all the time. Don't use it like a bill pay account. Like some people will talk about in infinite banking where you try to pay everything with it. That's BS. That's just somebody trying to sell you more insurance so that they get paid more. I always design it based on what their cash flow is like. If they're putting away $20,000 a year into their bank savings account, cool. Maybe we set the max on a policy at $15,000 or $18,000 a year, but they're only required to put in like $3,000 or $4,000 a year, So it creates a lot more flexibility and utility that you can use it that way. And it just works in coordination with becoming an emergency fund and also can become a funding source for your deals. And then, of course, using that to fund inside those deals and then pay back with a cash flow and rotating that money, just flowing it through back and forth, just like you would a savings account or a checking account. But now you're actually picking up more interest dollars than you would using a bank.